Hello, everybody, and welcome back to the Franchise Grow Show. I'm your host, Joe Carter. Today, we are talking about one of the biggest misconceptions in franchising. Most franchises or brands think that they are building a system when they're really just selling units. And there is a very big difference between those two, because selling units creates revenue, but building the system creates enterprise value. And if your growth is driven by volume instead of by operator success, it will eventually break. Revenue is the byproduct, but value is the objective. And value is only created when your franchise system is scalable, consistent, and operator driven. Today, I am super excited to be joined by Nick Vojnovic, the president at Little Greek Franchise Development. Nick, welcome to the show, sir.
Joe, thank you so much for having me on, and I really appreciate what you said there. I know that you're kind of coaching and teaching a lot of folks out there to be very careful when you look at a franchise. And certainly, I've been in franchising now for 40 years, and I've made mistakes. And so one of the things that we've tried to focus on at Little Greek is to focus on franchisee profitability, not growth, not trying to open as many stores as possible, not trying to take advantage. My goal, and that you hit the nail on the head, is trying to make sure we don't grow real fast. We do 3, 4, 5 stores a year. We just try to focus on trying to get them in for very inexpensive by finding they call them second generation shutdown restaurants. And so that is one of our things where we try to just take our time. Don't go borrow a bunch of money. Don't take a year to get an architect and blueprints. Because at the end of the day, Joe, you hit the nail on the head. The goal here is to have people making money successfully, happy with their business, but you're never happy unless you're making money. And that is, very impressive with you that you hit the nail on the head. That is the name of the game. And I see people out there, we're going to open 1,000 stores. My previous company, Beef Brady's, we were doing 50 a year, and it was just too fast. So Little Greek, we just do 3, 4, 5. We try to focus on owner operators. We try to find shutdown restaurants, keep the investment 150 to 300,000, and that really gives you a much more likely chance at success.
I love that. And 40 years of experience is a plethora. You mentioned mistakes, but I'm sure there's a ton of successes in there as well. So from your experience, what separates brands that scale from those that stall?
Well, you hit the nail on the head. I see people out there, opening, we're going to do 100 restaurants, and then they spread them out. We call them pioneer stores. Those are always the trickiest, most risky stores. Like Little Greek, for instance, we have 52 restaurants. We have 22 in Tampa, 12 in Orlando, 10 in Dallas, and we have 6 in the Midwest. I'm most concerned about the 6 pioneer stores in the Midwest because there's not the brand awareness. They don't have the purchasing supply chain support. I can't move employees around, and it's a much more difficult deal. So to your point, we try to fill in as much as we can the existing markets. One interesting caveat, which over my 40 years is new to me, and I know some of your folks you're doing podcasts with, they're not really in restaurant business, but they may be retailers. But we are finding today that 36% of our sales is either DoorDash, Uber Eats, or Easy Cater. And what's happening is it's spreading out a much larger zone of coverage. So in the old days, Burger King, McDonald's, a year, 1 mile, 2 mile, 3 mile radius, we had 3 miles. We're having to spread the stores out more because long-term financial success is the key. And if you start cannibalizing neighboring businesses, that nobody wins. And I see that happening. And I don't want to throw anybody under the bus, but Subway, for instance, they were opening Subways every, sometimes it'd be on opposites, 100 yards down the road. And ultimately, that's why they went from being the largest chain in the world. They're losing more, like 1,000 restaurants a year because they weren't focused on franchisee profit.
I love it. A lot of brands are focusing on selling units, and that's ultimately, to your point, Subway, that's where they go wrong. So how do you help a brand who has that mindset of, I just want to grow really fast, to understand that there's a better way of strategic scaling?
Well, Joe, I don't know. I mean, that's something where, I tell people sometimes, I go, you're doing, you're based in, Atlanta, and you're doing stores in Seattle, Washington, or but sometimes a young franchisor, I will tell you that like Little Greek, we've been doing this for 15 years. And when I first started, there was no income. And so when you have no income, there are a lot, fortunately I could afford it because we had sold Beef Brady's to a private equity firm. And I didn't have to pull cash out. So there is that little catch-22, Joe, where some young franchisors, they gotta bring cash in to feed the beast, to be able to pay for the overhead, to pay for the corporate staff. So it is a little bit of a catch-22, and I get it. Sometimes, people come in, hey, I want to buy, this big market. I'm willing to write a big check. I'm all excited. we actually turned those folks down. I didn't turn them down. I just said, instead of doing 10, let's just do 2 or 3. Let's see how it goes and make sure it can work. Joe, I don't know if there is a real answer to those folks. Sometimes they get caught up, I call it drinking the Kool-Aid. We're so good and we can do these everywhere and we'll just go. And that's where they'll fail. And we're in it for the long game. I mean, as you know, I'm old. I told you maybe if you could Photoshop some more hair on me for the viewers, that might be appropriate. But I've been around. I've seen them. Look at Quiznos. They went from 0 to 2,000 and they're back to 0. And when you see those stories over and over again, you learn and realize that each franchisee, that's a family. They're putting their life on the line. They're borrowing money or putting all their money into it. And it's as a franchisor, it's our job to certainly give them all the tools for success.
Couldn't agree more. The only metric that matters in the franchisor space is what success rate is my franchisees at. Profitability, vast majority of the time, is the actual metric, but that's the number we should be worried about, not the number of units that we sold last month. So let's pretend for a minute you get a brand that says, okay, we'll go down to just 2 or 3 units a year. What are those first couple of steps of franchise development when the goal, to your point, is long-term value?
Well, a good question. A couple of points, Joe, would be sometimes I'm not going to say just do 2 or 3. It's really up to the resources of your company, the ability of your training team and real estate and construction. Do they have the bandwidth and manpower to do it properly? It also goes into, if you're opening, 2 or 3 stores all over the country, it takes a whole day to fly to Oregon, for instance. So if you're concentrating your stores geographically, that's easy to cover. I don't have any problem with people doing, 5, 6, 10 stores, 20 stores. If it's done smart and they bring in the right partners and the franchisees are, they know what they're getting themselves into. They're prepared to train properly. So there's no real, I'm not going to say anybody who's opening 20, 30, 50, 100 is wrong. But you just want to make sure that they're being strategic about how they grow. And when I mean strategic, not growing for the franchisor benefit, but more for franchisees, making sure they'll be successful. The other thing we look at too, Joe, is if I can get a franchisee into a store relatively inexpensively, and for whatever reason, they don't work out. And I will tell you, I've had probably 500 or 600 franchisees in my career, and I wish I had the magic crystal ball that will tell me which ones will work and which ones won't, because it's hard sometimes to measure the desire, what's inside their heart. Then also sometimes you have a franchisee, great person, and personal things happen to them or stuff goes on in their life that affect their ability. But the key would be, if you can get them in relatively expensively, then I normally have other franchisees who are willing to buy them out, take them out. They don't lose their shirt. They maybe get some of their money back or all their money back, or maybe make a little money. But that's kind of what I look at is there are franchisors that every person calling in, they just want to put a new deal. And with Little Greek, we'll sometimes say, hey, this couple, they're going through a tough time. They want to sell their store. So instead of doing a new store, why don't you buy this existing store? And that way you have immediate cash flow. You know what you're getting yourself into. The systems are already there. The crew is there and the customer's already there. And it's a much safer bet. So, that's kind of what we look at would be, making sure that each folks have a success. And then what's the exit strategy? I see some brands, they have people borrowing $500,000, $600,000, $800,000. And if they don't make it, there's a huge debt on that building, and who's going to take over that note? And they're kind of stuck. And so that's kind of where sometimes people go the wrong way.
Couldn't agree more. I love the ability to help one person exit who's struggling and helping another person enter. You're kind of killing 2 birds with 1 stone there. That's amazing. I love that. How about unit economics? What are those non-negotiables for a concept or a brand to be scalable beyond their current geographic footprint?
Joe, very good. You're asking all the right questions, Mr. Joe. So when I first was looking around, I went to Cornell for hotel restaurant management. I worked for Applebee's, Chili's, a company called Famous Days. My big break is I came in when Beef O'Brady's had 30 stores, mostly in Tampa. And over 12 years, we got up to 270 stores in 26 states. And I remember when we sold beefs, I was all in, one of my key values is passion, and I really love beefs. I knew all the franchisees, their family, all the backgrounds and everything. But when we sold it, I would go to the restaurant industry conferences, and there's a fellow named Greg Dollarhide, who I tell people I'm a poor man's Greg Dollarhide. And I say, Greg, he did several really good brands. I said, Baja Fresh and Zoe's. And I said, Greg, what's the key? And you hit the nail on the head, Joe. He said, what are the unit economics? What's the 4 walls look like? What's the investment? what are the costs, and then what's my return on investment? Because at the end of the day, that's the name of the game. And if you want to go in kind of conservative, so with Little Greek, that's what I looked at was I saw the stores, very small footprint, like 1,200 square feet. And actually, to my point earlier, we're even going smaller because now, when I bought Little Greek, 50% of our business was eat-in, 50% was takeout. Out of the takeout, 10% was catering. We did 50% lunch, 50% dinner, which is a great mix because we have the strong salads and sandwiches, pita sandwiches. Then we also have the platters for dinner. But the key, I thought, was I'm in a niche where there's no competition. I'm not going up against Starbucks or Panera Bread or Five Guys Burgers. B, number two, it's a very healthy segment. We are on trend as far as people are watching what they eat, and we have olives and fresh salads and grilled chicken, and it's just a really healthy menu. The third thing was there's 4 stores when I bought the company. 2 were corporate, 2 were franchise. And they were already, I went in to go visit, and one of the stores had a terrible site. They were way in the back of the center, and in front of the center was Pancheros, Mexican, then a Five Guys, Papa John's, Dry Cleaners, Little Greek, way in the back. And we were outselling those stores. All the Five Guys and the Pancheros closed, and our guy moved up to the front. So what I was looking for was A, strong sales, B, a relatively low cost, which the original store she opened for $125,000. Food costs and labor costs need to be below 65. Ours is below, it's called prime cost. We're below 60. So those were the things I looked at was the 2 franchisee corner stores were making money. And, it was a kind of untapped market where there was not a lot of competition. And also, when you're looking for stores, sometimes if you have a pizza brand or sandwich brand and you go to a good grocery store anchored center, which is what we like, well, we already have a Subway, or we already have a Raising Cane's chicken. We can't put you in there, but Greek is kind of still a unique segment, so we got that going for us too. So back to unit economic model, that is the key. What do you need to do to make money? Can you do system average or even below and still pay the bills? And that's where Little Greek, our lowest volume stores, they're not making big money, but they're paying their bills and pull a little bit of cash out. Top people can make $200,000 or $300,000, but we try to tell them going in. If I say, Joe, what do you need to live on? He said, Nick, I need to make $200,000 a year. I go, Joe, I can't guarantee that. I wouldn't want you to push you in that situation. I think that maybe this is not the right brand for you. So sometimes saying no is the best answer, and it's really best for everybody. So unit economic model, you're hitting the nail on the head.
Go ahead.
The unit economic model is the key. And there are some people that'll mess around with their numbers. I know one chain, they'll say, "Oh, here's our sales," but that's actually their top third, and they break their top third into 3 segments. I go, those numbers don't make sense. Anyhow, so just be careful as you're doing your homework.
Couldn't agree more. And in the restaurant space, obviously cost structure is a very big unit economic you need to keep your eyes focused on. You reference under 60%. So what, if anything, can provide pressure to that margin?
Well, we're seeing it today. The inflation, tariffs. Our menu is pretty much commodity items, but tomatoes will spike up, lettuce will spike up, chicken will spike up. So that is, and I will say too that 2 years ago we had that inflation spike, and we've had to raise our prices 20% to offset the cost going through our stores because you have to maintain your margins, and that's hurt our sales. We've been flat for the last 2 years. Normally every year we're up 5 or 10%, but because we had to raise our price, the lower end consumer, especially now with gas prices, they can't eat out as much. So in our industry, there's these trends, and when times are good, you want to make your money. But when times are tough, you got to circle the wagons, and the survivors will be well positioned because, typically you always think doom and gloom, but it will kind of come out, and hopefully times will get better. So my advice would be try not to go in debt. I try to have all my franchisees go in all cash, because when you have that note every month, you got to pay SBA. And here's what happened to a lot of folks was they got these loans a couple years ago, and all of a sudden interest rates go up, and then they can't pay their bills anymore. And you see a lot of restaurants going out of business because they just can't afford to keep up. So we try to do all cash, try to go into what we call second generation shutdown restaurants, or buy an existing restaurant cheap. And obviously your listeners can do that with any model, not just Little Greek. Obviously our preference would be Little Greek, but and just be really conservative. Make sure you have backup capital. Make sure also that you financially are ready to, it takes time to build your business. I say, hey, first few months, you're learning it. Customers are learning what it's all about. Your employees are learning what it's all about. It takes some time to get where you're making money. But we're, be in it for the long game, and we're in it for the long game as well.
I love it. I love it. If you had somebody who was like, man, this sounds interesting, but how do I know if I have cash all in that I'm going to need? What investment range, well, do you typically see within the?
Yeah, I tell people that probably 150 to 200 cash would be the ideal. We've opened stores, including franchise fee, royalty, all that stuff for less than that. But you want to have some working capital as well, backup cash to go. So preferably, I would say the 200 to 300 range. If you said, Nick, I want to go build a new one, I want to spend $500 $1 million, I'd say, Joe, I'd rather you wait for the right location. We don't put pressure on people. There are some franchises that you have 6 months or a year to find your deal and get it open. We will let people wait 2 or 3 years for the right location to open up where you're set up for success. So I tell sometimes two people. I've had one person who came to me, and we do have a situation where you can borrow against your 401k, but I really don't like them borrowing money. However, when they borrow against their 401k, you're kind of paying yourself back. You're not paying a bank, and kind of locks in your interest. So, I think to be any franchise you look at, try to be really conservative. Look at go in there looking at the worst case scenario, and can you make it? And that's kind of what because all potential franchisees, they're like me, where bright eyed, the blue, sky's blue and the grass is green, everything's gonna be great. But you also have to plan for the worst case scenario, and that's why we try to be very conservative about that as well.
I love it. I love it. So 200-300K. Let's say that I'm a lead and I have that cash capital to invest. Obviously, you've referenced it a couple of times already. You go find those kind of second, whatever the term was used, second generation restaurants that are struggling that you can buy out.
Right. Yeah.
Second generation. How do you find those? Is it just within your specific footprint, or are there other networks that you're able to find and locate those for?
Great question. We normally will do couple things. One is with our system, our franchise fee is $35,000. So you put half your fee down, and then we physically go out to the market. We normally find tenant rep brokers who are real estate brokers who specialize, as we call them, inline space, which we typically want to be in Florida, Publix anchored center, because you get the people going shopping several times a week. Other areas, you'll be Kroger or Wegmans or whatever kind of a little bit higher end grocery store. In each market, there are very good brokers who are specializing, and we call them small inline tenants like Subway or Jimmy John's or Jersey Mike's or Little Greek, and those are the folks we look for. And actually, right now is the big, it's called the ICSC, it's the International Shopping Center group, and it's in Las Vegas. They have a big show, and there's probably 50,000 people. Restaurants are there, hotels, all the different folks are there. In the old days, Radio Shack or whatever, any retailer, and they're all there, and we actually are putting the word out. We'll do a blast. Hey, we're looking for 1,000 to 1,500 square foot second generation space in a grocery store anchored center in Atlanta. And that's actually, we're looking for a site up in Athens, Georgia. And so we have our brokers out there. She said, Nick, when I get back, I'll try to check and see what they have. So it is kind of got to be patient, because most brokers, it's easy for them to put you in a brand new centers being built. Sometimes you get what they call tenant improvement money, Joe, which I think you're aware of. The landlord will give you some money to help you build out the space. But it takes, you got to get an architect, get the blueprints, and right now construction costs are super high, equipment super high. So if you can buy an existing restaurant that's already kind of running, and there's AC units are there, there's a grease trap there, it's already, impact fees have been paid, the bathrooms are built to code, it just saves you so much money and allows you to kind of get in, open quicker, 60, 90 days, and not really put out the outlay that building a new space would cost.
I love it. This is like a world-changing environment in reference to flipping it on its head. There's plenty of businesses out there that are struggling. Look at the economy, right? So if we can give that next generation the opportunity to make it bigger, better, and badder through your system and the new operator, then it's a win for everybody.
Exactly.
But what is kind of the selection process? Because you've mentioned it a couple of times that not everybody's a good fit for y'all. So what is the selection criteria that you go through and questions you ask, whatever it may be?
Good question, Joe. So we normally, we love owner-operators. However, we do have some multi-unit franchisees as well, but we need people that are hands-on. So if you said, Nick, I have $2 million, I want to do 5 Little Creeks, but I have a Jiffy Lube and I have a hotel over here and I'm going to hire managers. We would look at your infrastructure, but I probably would say, Joe, I'm really concerned because I need somebody who's going to live, eat, and breathe Little Greek. These are hard. Restaurant business is a very demanding business, and you can't, get by with, a bunch of hourly employees from high school. And I will tell you, one of the negatives is our concept is fairly, our menu items are fairly they're extensive, tricky recipes. These are not like, at Beef O'Brady's, open up the box of, fried cheese and drop it in a fryer. Here we're cutting, slicing, dicing tomatoes, onions every day, lettuce. We're chopping up chicken, and we're making the soup from scratch. The dolmades, hand rolling them. So we really look for, I would say, Joe, who's going to be your operator? Who's going to be there every day? Who's going to be there when the AC unit breaks down? And that's where we look for people that are, and that's actually, yesterday I talked to a gentleman who is a sandwich chain franchisee. He went through 1 year training at that company. And I go, I am so impressed because, we look at the folks who want to train, want to learn it inside out and willing to roll up their sleeves. We don't expect you to do that the rest of your life. We have franchisees that maybe work 3 hours a day. They'll go on vacation for several weeks, but they've been doing it for a long time. They built a great crew. So to answer your question, you got to have the capital. If you say, Nick, I'm going to go borrow, I have $20,000 cash. I'm going to go borrow a bunch of money. I said, Joe, that's not the right deal. This is not a good opportunity for you. And I think that my advice would be sit tight, save your money, wait till you get a little bit better. Sometimes too, we get people, Nick, I love Little Greek. I got 2 little girls. They're, 7 and 8. I go, it's, restaurants are tough. It's a 7-day work, a 7-day week. Now, again, once you're up and running, no, but early on, it's a big commitment and you got to be prepared. If you have a nice corporate job, you're working 40 hours a week, I would say, maybe that's not for you. So we want people that really want to be their own boss, want to own their own business, want to have the ability to grow and have somewhere where they don't worry about 5 years later, somebody knocking on the door and say, hey, you're out of here. That our original store is 21 years old. So we tell them when you're doing a lease, you need to do 5 with 3 5-year options, a 10 with 3. Make sure you tie it up for 20, 30 years because hopefully this is a long-term business and hopefully your children someday might want to take it over as well. So number 1 would be they have to have the capital to do it. Number 2, are they willing to get involved, roll up their sleeves? So me, Joe, I like people. We've never really done any franchise sales advertising. Normally it's customers because I want people who are passionate. They love our food. Oh, I didn't know I could open my own. And that's kind of people I look for. So if you said, Nick, I'm looking at Jiffy Lube or Little Greek, I go, I don't think you're really our guy. Or if they say, well, Little Greek, I calculate I can make a 15.7% return. At another brand, I'll make 15.8. I'd say, well, we want people that love Little Greek. Our food is wonderful, Joe. We really work hard. We have outstanding. It's a little bit of an Americanized tweak on Greek food. It's not like that real strong Greek vinaigrette dressing. It's a little sweeter flavor profile, but the food's wonderful. It's healthy. So I want people who are passionate about Little Greek. They really want to grow with us and be part of the team. And it's, as you know, Joe, franchising, we're a family. It might be a dysfunctional family. We're stuck together. We have people now that have been signing their second 10-year renewal. So my kids know their kids and they're kind of growing up. And now we have franchisees that started, they're single. Now they got 4 kids. And so it's a long-term play. So number 1, cash. They need to have the capital to do it. Number 2, they have to have the desire and the ability to kind of roll up their sleeves and get involved and work hard. And the second part would be making sure the intangibles are there too. That financially they're in a good spot where they don't have to worry about cash. They want to get involved in the store and they love Little Greek. So I always tell them, go eat our. I love it. Yeah, go try out the food. The gentleman called me from, we talked yesterday from Miami. He has a 8 sandwich chain. I go eat at our Boca store. And if you don't like the food, I wouldn't go there, because you want to be proud of what you serve and it's healthy and, you're doing people right.
And I think I heard you right earlier is that there's one in Dallas, right?
We have 10 in Dallas, 12 in Orlando. And we cater for
I gotta find the closest one.
Yeah, we'll set you up, you guys up for dinner. We cater for the Cowboys. We do weddings. We cater for my son's wedding. I mean, the food is amazing. So we have steak, we have lamb, we have the gyro, which is 90% ground beef, 10% ground lamb. What part of Dallas are you in, Joe?
Northwest, close.
So we have we have one in Capel, but we also have McKinney up that way, but that's more northeast, right? Yeah, we'll get you. You'll be eating some great food.
Capel's not far.
Yeah, as soon as we're done, we'll set you up.
Boom. That was a side comment.
Bring your crew in.
I love it.
Right? Because again, we want people eating the food. That's one of our big things. And then also the final thing, Joe, we look for a culture fit. We look at it is we're all in this together, and we want to make sure we all can work together, and we're our team players. Some people have a little chip on their shoulder, and we probably would pass on them. We don't need conflict. We don't want to have friction. We're not perfect. You're not going to be perfect. We got to work through problems. And so sometimes if I sense that somebody's going to be really combative, we'll probably pass on them as well. So our key culture points would be passion, integrity. I want people open and honest. Number 3, you got to have quality operations excellence, constantly get better. And then number 5 is give back. Help out the community. We set up scholarships. We do donations and fundraisers and things like that as well.
Amazing. Like, post startup phase, the restaurant is operating. What support does the franchisor provide that owner?
So we typically come in and we have a 4 to 6 week training program, depending on your background. Well, obviously, we've helped you find the site. We help you kind of guide you through the construction process. We bring an opening team out for 2 weeks to kind of help with the opening and transition. And then they're kind of on a regular basis, kind of helping back and forth. And then we have operations people that will check in. Our operations people, good or bad, they're not the ones coming in and saying, this is wrong, this is wrong, this is wrong. You need to scrub that air vent. They're more, how's it going? What can I do to help you make more money? We're looking at it as a partnership. And we're not here to beat you up. And that might not be, some people want to be beat up, but we are all, hey, this is a long play and we're here to work with you. But at the end of the day, most of our franchisees have been there now for 10 years. And so a lot of our visits are social. We'll go smoke a cigar. We take them out for dinner. I will say that in the franchise business, I even have good friends who are great operators. I don't get enough support. What do you want us to do? I mean, I can go there and I'll bust tables, but at the end of the day, you're kind of buying a business model, and we give you like, here it is, be successful. We'll show you ways to make more money. Some people won't listen to us, but at the end of the day, we're not going to be there. We don't charge a marketing fund, but we do supply, brand support. We do all the replies to, the reviews and things like that as well. I will tell you that if you're coming to my system and you expect me to be in there every week and supporting you by, we're there more for like an insurance policy. We had a situation where there was a confrontation in one of our restaurants. We're on the phone. We're talking to the PR firm. We're making sure, let's get hold of insurance people. We're there more for helping when you have issues and concerns that a normal person would be struggling with. And then we're also there just kind of, hey, here's some ideas of ways you can make more money, some ideas of things you can do. During COVID, we were leading the way with different programs to kind of get them through that program as well. So we have operations people that go out, but we're not in there every week. We're not in there, there's a chip of paint over here missing. We expect this is your business. You own it. You need to take good care of it. You need to be reinvesting in your store. You need to be reinvesting in your employees and taking care of them as well. But we're here to help you and give you great ideas. We do a weekly newsletter. We have videos and training things as well. But it is tough. But I do sometimes take a little umbrage with franchisees who are like, I don't get enough corporate stuff. I go, this is a franchise business. We're here. We have our job to do. We're going to get you supply chain. We're going to make sure we're handling issues. We're trying to keep us relevant. And we're watching out on a national scale. We're negotiating the best contracts we can get. But at the end of the day, that day-to-day ops, that's your baby. And, we're going to give you coaching and teaching and advising. But like sometimes, I'd say, how much money can I make? How much money do you want to make? I have some franchisees, they're working 40 hours a week. I go, when I was a franchisee, man, I worked a lot more than 40 hours. I was out there hustling. And I go out after and go visit businesses in the area. So that's one of the things too. How do you measure that when you're looking at a potential franchisee? We ask the questions, but until the rubber hits the road, you never really know.
Couldn't agree more. And there is such a thing as too much support, in my opinion, out there with some franchise brands where they're micromanaging the heck out of the franchisee. So having some flexibility for the business owner to be able to operate the business as though he's the owner and have the capacity to do so without having to read the entire franchise manual. Am I allowed to do this? Am I allowed to do that? Just go get it done. If it's going to drive your business, go get it done.
Yeah, when you do a franchise, you're trying to be your own boss. There's one franchise company that actually has TV screens, and they'll yell at employees because they're in the, which I go, who can do that? And I guess maybe it's, who knows? But I go, I just can't imagine being that level of kind of big brother watching over people. I mean, this is their business. And like I said, how much money do you want to make? You can make a lot of money, you can lose money, or you can break even. It's, how hard do you want to work and how good are you with your employees, your customers, and running. Restaurants are tough because you got to wear a lot of hats. You got to be a culinary person, you got to be a marketing person, you got to be a business person, or there's a lot of things you got to do. Now we take a lot of pressure off you on parts of it, but at the end of the day, you're in there every day making it happen.
Couldn't agree more. If there's somebody out there that's listening, and I've been thinking, and I think I got a client I got to make an intro to you for. But but separately. If somebody's listening to this particular episode and they're like, this sounds really interesting. I love the concept of second generation. It's a lower investment model and trying to get in something brand new. It's obviously in the kind of the healthy food space, which is of interest. If all those boxes are checked and they want to hear more, learn more about the process and see if they're a fit for you and you're a fit for them, what's the first step they should take?
Oh, great question, Joe. I'd say the easiest thing would be to reach out to me. I like LinkedIn. Nick, Nick Vojnovic, Vojnovic. Looks like Vojnovic. Put me on LinkedIn because I do guest lectures, free bad advice. I go to I'm on the board of directors for the business school at University of South Florida. I say, here's 20 of my top 100 career mistakes. And sometimes I like talking to other people like you, restaurant people in the franchise business. I always learn something from everybody. So my thing would be, obviously you can go to our website, mylittlegreek.com, Nick Vojnovic at mylittlegreek.com. But LinkedIn is a great way. You can see my background. You can kind of get in. We can kind of start chatting a little bit, and just a great way to kind of network through. Or call Joe Carter, and Joe can hook you up with me as well. So you're the man, Joe. You're my guy. No, but I really appreciate what you're doing. Is it's a tough world out there, and a lot of people. They want to sell and they're out to try to make a dollar. And I get that. I mean, that's part of the business, but your job is try to enlighten people, let them know what they're getting themselves into, make sure they're making a good educated choice because, it's a big decision. I tell them, go spend a couple days in the store, make sure that this is what you want to do because once you're in, it's not like, oh, gee, I changed my mind. You're in and you got to make sure there's an exit strategy there as well.
100% agree. And if you didn't catch like the website or the LinkedIn profile, no worries. Just scroll down in the commentary. We'll put all the hyperlinks in there. So if you are interested and you want to vet out this brand, you can reach out to Nick directly. But I love the fact that you serve that right back to me and say, reach out to Joe too. I would be happy to help make the introductions.
Thank you, Joe. Thanks for all your help, and I really appreciate what you're doing. Best wishes to you, and I do want to treat you and your crew there to a meal at Little Greek.
I would happily accept that. This was fantastic, Nick. Thank you so much for being on. Running a brand is a full-time job and then some. So I know you're a busy guy. I appreciate you taking the time out for myself, the audience, and just sharing some insight of 40 years of experience with me and with everyone else. Thank you.
Thank you, Joe.
Awesome. Well, for everybody out there, here was my biggest takeaway. Franchise brands, they can fail, they can succeed. But most fail simply because they're out there trying to sell units and trying to sell operator success. And Little Greek does it the right way because they are there to make sure you, as the operator and the owner, are consistently successful. Remember, revenue is a byproduct. It's the system that creates the value, the documentation that protects it, and the accountability that sustains it for the long term. Little Greek's got all of that. So if you are serious about getting into a franchise that can scale and become a sellable asset, reach out to Nick and his team or visit twinflametx.com and apply for advisory. Until next time, I wish you all a great rest of your day and look forward to seeing you on the next episode. Thanks, everybody. Bye.